There's some firmness in this report here, and kind of interesting that Fed Chairman Jay Powell has kind of come off his idea that some of the decline in the CPI and the inflation number was transitory, just as some of the transitory things reverse themselves. First of all, you have this big decline in gasoline prices. I think that appears to be reversing itself. Big increase in apparel prices, 1.1%. Remember, we went through that whole thing about how there was this change in methodology, the use of big data. That drove down prices. Well, now it's come back as well. Medical care has been up 0.3%. And some other factors in here look like they're pretty firm, including housing, shelter. This is going to translate into perhaps a somewhat higher PCE core, which is what the Federal Reserve uses most, but certainly it doesn't look like it's declined. The other thing that's interesting is the jobless claims number tells us that the job market remains pretty strong, and maybe that 200,000 plus number we got on Friday was not a fluke. So it's pretty interesting that you still have this firmness in jobs and firmness here in inflation. We'll see if that continues.
Yeah, we certainly will, Steve. And Jim, fit this into the general outlook here. I mean, do you think the market's going to have to do a rethink on maybe not whether we get a cut in July, but just how deep it's going to go and what this process is all about?
We're not making this rate cut easy, are we? We keep challenging it. Fed's going to be cutting rates with a pretty strong job market and inflation turning back up at full employment. I think they're going to
back at 8,500 maybe. Who knows?
I think they're going to do it, but it's difficult to make the regular case for easing right now. I think there's still a good case on two fronts. One is the Fed funds rate is so out of bounds with any rate in the world today, just to get in the same zip code as the rest of the world assesses things. And then I still think, too, that we got the inverted curve and they could fully take that risk out of the marketplace. I still think even with the hot CPI number today that if the Fed looks at its two risk, which one's more of its dual mandate, which one's riskier, I still think you come on to the riskier is the growth side of the equation. And if inflation comes up, to some extent, I would like to see inflation come up before the next recession. Because if we go into the next session with the ability to show some overheat, that might be a success. So I think the Fed was going to go ahead but they're not making this easy.
No, they're not. And how are markets priced, I guess, for that scenario? Right. Both the fact that inflation might actually have a little bit of life in it, and the fact that the Fed maybe is going to do this one and then wait and see for a while.
I think all along they're one and done. I really kind of do. I'm kind of interested. There's not a lot of people expecting accelerated economic growth looking forward. Hardly any economists are predicting that. And yet, if you just step back from everything we're doing, we've got the money supply. The real money supply has gone from 1% to 2.5%. We've got a 130 basis point drop in long-term yields and yields across the spectrum. We've got fiscal deficit as a percent of GDP going from 3.7% a year ago to 4.7%. With all that stimulation, normally everyone would be predicting a pickup, and virtually no one is. I think it's going to pick up. And that's why I think the Fed may cut this rate, but then I think they're going to be done because I think rates might be going up before the year's out as the economy starts to come back.
Have we seen, Steve, Fed funds futures move in terms of the pricing in for later cuts at this point on the back of this number?
If Paulsen wasn't so darn compelling, I would have been looking that up. But instead, I was listening to his argument here. I'm clicking on it now. It's going to refresh in a minute. I don't see it really move. No. You're still 100 on July. You're still 77 on September. So, no, that rate cut is still pretty much baked in. Hey, guys, we have Sheila there, and I didn't know she was going to be there because I didn't look at the guest list, but I was going to call her today because I have an interview with Fed Vice Chair Randy Quarles. Hey, Sheila, would you mind? She's not there?
No. Sorry, Steve. She left.
Man, I have to call her. All right. I was going to ask her about some of the banking changes out there. But let me just say one other thing, which is Jim is right that most people are predicting weaker growth. The kind of belief in the continuing benefits of the tax cuts, people pretty much dialed out, along with the idea that I think they wrongly dialed in the idea that the spending from last year was going to be in 2018. But in fact, it seems to have come over, and the Journal actually wrote a story about the missing stimulus in the national accounts that I think eventually shows up. So, Jim, could you just put a number on that? Are you at a 2.5 to 3. Are they going to get the glorious 3% number again later this year?
Well, I think, I don't know about 3, but I think we're back in the 2-ish to 2.25, 2.5. And what's wrong with that? That's been the growth of the entire recovery, and it's been wonderful for bringing the unemployment rate down and wonderful for putting stock market up. So I don't see where that's so bad. We had 3 growth in the first quarter. We're probably around 2 in the second. And the fundamentals or the internals of the second quarter, Steve, are going to be better than the first. And I just think people are a little too pessimistic on this slowing down. One big oddity, we've never had fiscal stimulus this late in a cycle to this magnitude before. And I think that's going to screw with everyone's traditional playbook here. I think the yield curve may be inverted, but this is the only time post-war history we've had an inverted yield curve with expansive fiscal juice. And I'm not sure which one's going to win out. I suspect it'll be fiscal policy.